All right, let's get right into it. Today, we are cutting through all the noise surrounding the Iran-US conflict to give you the view from the inside. We're not going to talk about headlines. We're going to talk about how the big money, the real money, is actually playing this situation across every single asset class. Let's break down the playbook.
First things first, this is probably the single most important idea you need to grasp. While you see wall-to-wall coverage about a potential war on the news, the people who are actually moving billions of dollars around see it very, very differently. So, if it's not a war, then what in the world is it?
Well, in Wall Street jargon, they call this a geopolitical volatility shock. Just think of it less like a long, drawn-out war and more like a sudden, sharp earthquake. The market isn't betting that the world has fundamentally changed. Nope, it's simply trading the uncertainty itself, and more importantly, how long that uncertainty is going to last. The key question isn't if there's a shock, but for how long.
Okay, so let's push all the cable news chatter and the political rhetoric aside for a minute and focus on the one thing, the one trigger that truly drives every market reaction we're seeing right now.
It all comes down to this one tiny strip of water, the Strait of Hormuz. There's a reason they call it the jugular vein of the global economy. You see, any disruption here, whether it's real or even just a threat, doesn't just cause a local problem. It sends an immediate shockwave right through the entire global financial system.
And how does that shockwave travel? Well, it has one main vehicle, and that's oil. You have to think of oil as the main character in this drama. It's the mechanism that takes all that geopolitical tension and turns it into real dollars and cents risk for absolutely everyone.
And this number, this one right here, is why everyone freaks out. About a fifth, 20% of the entire world's daily oil supply has to squeeze through that one little choke point. You don't have to be an economist to get this. Threaten a fifth of the world's oil, and boom, you've just threatened the entire global economy with an inflation crisis.
Now, what's fascinating here is how oil has been trading. It's not random. It's following this really clear three-step dance. First, you get the shock. That's the initial spike based on fear alone. Then comes the squeeze. This is where all the automated trading programs, the robot traders, are forced to jump on the bandwagon and buy, which pushes the price even higher. And finally, you get the reversion. The second a positive headline hits, a hint of de-escalation, the price just collapses as all that fear disappears. The bottom line? Oil isn't acting like a boring commodity. It's trading like some crazy, volatile meme stock right now.
So that brings us to the stock market. And this is where so many people get the story completely backwards. That old assumption that conflict is automatically bad for stocks, well, in this case, it's just plain wrong.
See, on one hand, you have the everyday investor thinking, uh-oh, war is bad, sell, sell, sell. But the pros? They're playing a totally different game. They understood that only a prolonged, sustained spike in energy prices would really hurt the economy. Their bet was that this conflict would be short and contained. So that initial dip in the stock market, for them, that wasn't a fire alarm. That was a dinner bell, a buying opportunity.
Okay, so if the big money was buying the dip, where exactly was all that cash flowing? This event didn't just affect prices, it kicked off a huge global reshuffling of capital. Let's follow the money trail.
This chart right here says it all, doesn't it? As soon as the tension started to build, money just gushed out of more exposed regions like Europe and other emerging markets. And where did it go? It flooded right into the US stock market. It was a classic flight to safety on a massive scale.
So why the US? Why is it this safe harbor in this storm? Well, it really comes down to three huge advantages. First, the US is a net energy exporter now, a huge game changer that makes it way less vulnerable. Second, because of that, its economy is just better insulated from an oil price shock than, say, Europe or Japan. And finally, when things get scary out there, global money always looks for one place to hide, and that's the US market.
All right, so given everything we've talked about, how are the big hedge funds actually setting up their bets for what comes next? Let's open up the institutional playbook and look at the three most likely outcomes they're preparing for.
The first thing you have to look at here are the percentages. It's all a game of odds, and the overwhelming bet, a 70% probability, is on what they call the base case. This is a world where the conflict stays contained and any disruptions are temporary. So the trade is to own stocks, own safe haven government bonds, and sell those temporary oil spikes we talked about. The other scenarios, a full de-escalation or a total disaster, are seen as much less likely, long shots. The big money is positioned for a manageable situation.
So, how do they know if things are changing? Well, I can tell you what they're not doing. They're not glued to the 24-hour news cycle. They're watching a completely different set of signals. They're asking, are oil tankers actually being stopped, or are we just hearing threats? Is the U.S. Navy really escalating its presence? And maybe most importantly, is overall market fear, volatility, going up or down? Those are the signals that matter.
And this all leads us to the big $1 million question. Right now, the market is calm. It's positioned for a contained event. So what's the one thing, the one signal, that could completely shatter that calm and force everyone to reprice risk overnight?
Look, if you take away only one thing today, let it be this. The entire institutional playbook, all of it, boils down to this one simple idea. As long as the market believes any disruption is temporary, the trade is to buy risk, to buy the dip. But the very moment that perception flips and the disruption starts to look structural, like it's here to stay, the playbook doesn't just change, it gets thrown out the window. And the new rule is simple: sell everything. That is the tripwire.